We wanted to bring up the topic of risk. Uh, Risk has to be calculated, guys. Uh, Sooner or later, you will have to encounter into statistics. You will have to encounter into analytical tools and everything. But there is a foundation which is important to understand, and we will try to get into that in the simplest possible way that we can, and introduce you to the topic. And then as the last time we did, we're going to touch upon the examples of derivatives. As promised, we'll look into the options a little bit more. For, well, again, simplicity purposes, we have avoided things like credit default swaps, interest rate swaps, because they are a little bit more complicated, but we can certainly discuss them. If you are interested, there are huge markets as well as the others that we are going to touch upon. So yeah, let's have a go. We will talk about risk management today, and in order to understand it, we will have to first talk about the risk itself. It is usually associated with the downside or bad outcomes, but with financial risk, it's a little bit different. And only looking at the downside will be a mistake, because managing financial risk is as much about exploiting the opportunities for gain as it is avoiding the bad things or the downside. I will say the downside a lot. It just means the bad part of it. Therefore, the risk combines both the uncertainty and the utility or benefit of the outcomes. And for financial firms, the future outcomes are always profits. Profits and losses measured in monetary units like dollars or rates of return. And the primary objective of the financial firm is to maximize profits. I keep on having this message delivered to you every time. We have to remember that risk is personal. Everyone will treat risk differently, so it's different for you and me, and for firms as well. And it is important that when we look at the financial firms, we review the risk that they have as the distribution of profit and loss. It gives us the understanding that the risk is multifaceted and it cannot be defined as a single number. Therefore, we need to consider the full distribution of possible outcomes which come with the portfolio. So there are two types of risks: idiosyncratic and systemic, or we can as well call them beta or market-wide risks. The beta and market-wide, they usually measured with CAPM, which is capital asset pricing model, which is not the perfect but generally accepted tool to measure the risk of the portfolio. So to begin with, idiosyncratic risk, it is the risk that is particular for the firm, and systemic risk is widespread across the financial system. The distinction between the two is very, very important because they have different origins and different strategies to deal with them. For example, take the collapse of Lehman Brothers and AIG Insurance in 2008. It was related to a systemic risk to the crisis in the housing market and wider credit market in the United States and worldwide. But when a local German bank goes into insolvency, very limited public is affected by that. So the distinction between them is important for two reasons. First, the sources of those two risks are different, as I have mentioned. With idiosyncratic risk, it arises from within a firm and generally under the control of the firm and its managers, whereas systemic risk is shared across firms and is often the result of misplaced government interventions, inappropriate economic policies, or exogenous events such as natural disaster or crises that might happen here or there. As a consequence, the response to the two sources of risk will be quite different. Managers within a firm can usually control and manage idiosyncratic risk, but they often cannot control the systemic risk for obvious reasons. And more importantly, firms generally take the macroeconomic environment as given and adapt to it rather than, work to alter the systemic risk environment. So some companies, for example, banks, they may take certain actions, not looking for the particular outcomes, such as we have example in 2008 when this crisis happened, mainly because of the activity that the banks got involved into with credit default swaps. And the second reason for the distinction and why it is important is that the consequences are quite different. A firm-specific risk disaster is serious for the firm and individuals that are involved, the stakeholders, but the repercussions are generally limited to the firm's owners, debtors, and customers, the stakeholders. With a systemic risk management disaster, it's a serious macroeconomical and larger society implication. Consider things like Great Depression in the 90s. There are a few of them that we can list, but the greatest is the Depression of 1930s, Asian crises in 1980s, 1990s, or the recent one in 2008. These events, they all involve systemic risk and risk management failures and had a huge cost in terms of direct bailouts or indirect costs to the overall economy in the forms of lost outputs because many firms went out of business, savings got lost, and this all caused more serious damage to the economic cycles. But we should concentrate on the risk that firm is able to control. In order to do that, we have to identify the risk. We have to go into the risk measurement. Before we go deep into that, it's unfortunate that the term risk management has been appropriated to describe what should really be called the risk measurement. The measuring and quantifying of risk is the risk measurement. It requires specialized expertise and should generally be organized into departments separate from the main risk-taking units within the organization, and managing risk, in contrast, must be treated as a core competence of a financial firm and those charged with managing the firm. Risk measurement has three main goals. The first one is to uncover the known risks faced by the portfolio of the firm. And by known risks, I mean risks that can be identified and understood with study and analysis because this or similar risks have been already experienced and encountered by the company in the past. Such risks often are not obvious or immediately apparent, possibly because of their size and diversity of portfolio, but this risk can be uncovered with diligence. The second goal of the risk measurement is making the known risks easy to see, to understand and compare. In other words, the effective, simple, and transparent display of reported risks. Tools such as value at risk that we're going to discuss a little later, or VAR for short, is a popular tool in this arena, but there are also other complementary techniques and tools that different firms use. And in many cases, we have to also understand that in different companies, they will be using different tools that are tailored. But those are the most popular kind of in the academic area. That's what we will be taught. And then if we go, or in the industry itself, each firm will have the tailored one. And the final goal of the risk measurement is trying to understand and uncover the unknown or unanticipated risks, those that may not be easy to understand or anticipate, for example, because the organization hasn't encountered them before. Here I made a short list, as I have told you, of the tools that the companies use. VAR is, the most popular in the academia, what we encounter the most. It is a statistical tool used to assess the level of risk associated with the portfolio or a company. It measures the maximum potential loss with a degree of confidence for a specified period, for a specified portfolio of the firm. Then there are things like standard deviation, which is basically a measure of dispersion and possibility of outcome, as well as Sharpe ratio and R squared, which is used there as well. So this is risk measurement, which again serves three major roles: uncovering, identifying the known risk, dealing with it, and then uncovering the unknown risk. With the risk management, it's a little bit of a different term. Risk management is about communicating risks up the hierarchy and managing risks from the top. It is essential that all risk takers and risk managers speak the same language in describing and understanding it. because the firm's success depends on it. Managing risk is not about minimization of risk. It's important to understand. It is about controlling the downside and exploiting the upside, extending the focus from passive measurement and monitoring of risk to the active management of it. It also drives one towards tools to help identify the types and directions of risk and also to identify the tools that help hedge that risk and develop strategies to alter it. Risk management is about managing people, processes, data, and projects. It is not just quantitative techniques, it is everyday work of actually managing an organization and the risk it faces. It requires making tactical and strategic decisions to control those risks that should be controlled and to exploit those opportunities that should be exploited. Managing profits cannot be separated from managing losses or prospect of losses. That's why we have the whole thing. Managing risk must be a core competence for any financial firm. To manage your risk, you have to understand the sources of risk in the portfolio and what trades will provide an effective way to reduce it. It requires additional analysis and in particular a decomposition of risk and ability to find potential hedges and ability to find simple representations for complex positions that you might have in your portfolio. Effective and intelligent and useful risk reporting is as important as the underlying analysis because as I have mentioned previously, usually the risk measurement department will be separate from those units that the decision makers that need this information. Therefore, this established link and communication of risks has to be developed and present in the organization. So we're moving on onto derivatives, picking up from the last lecture. I think you have seen this example already. We have discussed the farmer and the apples. I think some of you haven't been here, but let's go over it again. Or is there anyone from the last class who wants to participate and help me with this one and to see if you have understood and remember what happened last time? Well, probably no one. So the futures and the forward contracts, we have discussed them in the end of the last class. Future is a standardized contract which is traded on an exchange, which is very helpful to protect both parties from the default of the opposing party. It has specified amount and it has specified date of expiration. So I think you might have read the whole example already, but let's go through it again. Let's assume we're a farmer and we expect to harvest 100 tons of apples in August. And it's March right now and the price for apples is 100. And we expect to harvest 100 tons, which means that we will have a long position in apples in August. The spot price in March is 100. We expect the market for apples this year to be very good. A lot of harvest. Hence, the prices will drop according to the basic economic laws. When there is a lot of supply, the prices will go down. So we enter a futures position, which is a standardized contract, as you remember, and we say that we will sell, because we're long in apples in August, we will sell them for 105 at the market. We want to protect ourselves from decreasing prices. But when August comes, the price of apples is 108. It has been a bad year. There was not a lot of rain, so it was drought, and the harvest is not the same, and it's limited. And according to the same economic laws, the price with limited supply is increasing. But we have an obligation, a futures contract, and we have to deliver our apples at this price. And relative to the spot price in future, we're going to lose 3 per tone. Is that clear with everyone? I assume it is. Yes, so with forward, it is similar to the futures contract, but one fundamental difference is that it can be tailored. It can be tailored between me and you, companies, institutional investors, but the principle works in the same manner as it is with the futures. A more complex derivative that we wanted to touch upon today is options. They're a little bit more complicated, but as I said in the annotation, we will use 2 simple examples to demonstrate you how they work. So options, it's not an obligation. According to the name, it's an option to buy. So when the time of expiration of this derivative comes, you have an option to buy, but you don't have to. But there are certain mechanisms that are involved in that protect both parties, and there is an incentive called the premium, which is paid to the option issuer in the beginning when the contract is drawn up and both parties sign it. The option issuer, he receives the premium. So we're going to look at 2 types of option, which is a call option and a put option. Simply, a call option is the right to buy an underlying asset, and a put option is the right to sell an underlying asset. So let's use the same example with apples. Let's decide that you want to buy a call option. So that means that in future, you will have an option to buy apples at a certain price. You are shorting them now, and you want to acquire them. You enter an option contract, which has a strike price of 100 and 5 that you have to pay as premium. And here we have a little small diagram with the scenarios of what could happen in future. So you have paid 5 in time t0. It has already been paid, and you have the right to buy apples for 100 in time t plus 1 in future. But when time t plus 1 comes, the spot price in time t plus 1 could be either 120 or could be 92. Do you have any ideas what happens when you have entered the call option with a strike price of 100 and a premium of 5 that you have paid in T0?
Well, obviously you won 15. Yeah. Just as a quick side note here, for anyone who can't follow, it's no problem. Just raise your hand or write in the chat, and then I would see it.
Okay. I will continue with call option, and then with the put option, we'll see if anyone wants to answer. Then, okay, when the price in time t plus 1 is 120, as Alexander has pointed out, you win 15. You have paid 5 in the beginning, and now you have the right to buy the underlying apples for the price of 100. So you take the total sum of 100 plus 5, and then you take 120 and just minus 105, and it means that you have gained relative to the market 15. So you can buy this apples at the strike price 100 and sell them immediately in the market at a higher price of 120. But when the price goes down, do you have any idea what happens then?
You would pay too much, right? You would pay 13 all over the market.
No, you just don't call your option, so you can take the lower price.
Exactly. you take the lower price, but you have to also remember that you have paid 5 as a premium in the beginning. So you would have to, yes, you just pay the premium. And this will mean that you don't exercise your option. You pay the premium and you pay the market price on this particular day. So your total exposure will be 97. This is it for the call option. I'm very glad there was involvement. And here is the put option. In that situation, you're long in Apple, and you enter the put option contract, which gives you the right to sell at the price because you expect the price to go down. So in this case, the strike price and premium, they remain the same. What do you think will happen in future when the price for apples is 120?
Yeah. Sorry.
Sorry, go ahead.
I would sell the apples for 120 and cut the put option.
Yes, but you forgot about the premium.
Yeah, sure. Sorry.
Yeah, so you would not exercise it, but you will also have to remember about the premium that you have paid, and you will have to deduct it from your overall profits. Let's think about what happens when the price for it is 92. What happens then? Entering a put option, your idea, you wanted to protect yourself against the drop in prices, correct? So this has happened. The price in the market is 92, but you have an option to sell at 100. So you exercise your option, but you also have to remember that you have paid 5 as a premium. So you will sell your apples at the price of 95. Not in 95. You will sell your apples at the price of 100, exercise the strike price, but you also have to remember that your net position, it has to include the -5 that you paid as the premium in the beginning. So overall, your gain will be 95 at the spot in August. Is that clear to you? Okay, then I'll take it as a yes. Well, I think here we would stop with the risk lecture. Do you have any questions? Are there any questions about the types of risk or about particular derivatives that you have, guys?